So let's jump in and talk about the two key considerations or the two big levers that you can throw when you're trying to structure an offer or negotiate a deal. There's probably over 100 different things that you could negotiate on or talk about or use to alter the terms of the agreement or sweeten the pot a little bit, but they all generally fall under two categories: cash and terms. I used to always say price and terms, but I changed it to cash and terms for how I think about deals when I'm structuring them because it's a little more all encompassing than just the price. So when we talk about it with our clients, we talk about the money spent and the price paid. So the cash can be a little bit different than just the price. Price is how much you're paying for the property, but it doesn't speak to win at all. And it doesn't talk about how much cash the seller is getting. And it doesn't talk about other things like earnest money, closing costs, different things that you can consider. If it typically costs 2 to 3% on top of the purchase price to close a house, to get the financing, do the appraisal, do all the stuff that you do on a $500,000 house, that's $10 to $15,000. Well, what if you could pay $515,000 but not have to pick up any of those costs? You're paying more for the house, but your total cash out of pocket is still the same as buying the house for less with the other costs. So we like to focus on total cash to acquire and price, not just price, because cash is important and a lot of people can put value in being able to keep cash in their pocket. I know that I do. If I could buy something zero down and still make it pencil the way that I wanted to versus putting 50% down, I'm going to go the zero down way and keep my cash in the bank in case life throws some surprises at me. So we're talking about the amounts of the purchase price, the earnest money, and the down payment amount, as well as closing costs when we're thinking about cash into the deal. And then there's kind of when you're starting to deliver those things, which are the terms. Terms are how and when things happen and what things need to happen to make a deal. Typically, contingencies are main terms. When is it going to close? When is the seller getting cash? Those are all terms that you can use to negotiate in a transaction. So you think about cash and terms, those are two good levers to focus on and see what you want to do. When it comes to deal negotiation strategy, at again a very high level, there are kind of two strategies that I like to explain to people when we're looking at a deal. We can get your price and their terms, right? If you were negotiating with me, I would say, look, you can have your price, but I want my terms. Or the second strategy is we can do my price and we'll do your terms. So I'll give you an example. If you're a seller and you want, you know, $600,000 for your property and it's an investment deal, or even a house I'm looking at moving into, I might think 600,000 is a little bit high, but if you let me be creative on the terms of when I close, maybe I need to sell something else, maybe I need to save some more money, maybe I need to do something else. You'll let me be creative, maybe I'm willing to pay the 600. Or if you want to go really fast in the timeline and drive your terms, you want a really fast, clean offer, no contingencies, no headaches, and you want to close in 2 weeks, well, then I want my price, which is going to be lower. So that's an example of a couple of those things. And I'll talk a little bit more about a couple examples in a minute. The way to make the deal is to find the right combination of those two things that works for you. So again, back to that Venn diagram where I had the buyer and the seller and then the appraiser in the middle. This is the same thing. Clients are usually saying, well, I would pay, it's listed at 600, but I would go up to 620 on it. So they've got a $20,000 range. And the seller might have said, well, I've got it listed for 600, but I'd go down to 580. So now you've got a $40,000 range to try to make a deal in. The seller might say, well, I want to close in 20 days. And the buyer might say, well, I don't want to, I'm willing to go as fast as 30 days or 20 days, but up to 60 days. Now you've got a window range of time that you can try to talk about. So you want to find the right combination. Ideally, stack to your favor, sure, but it doesn't have to be a make or break. It doesn't have to be beating the other party in the transaction on every point that you can try to beat them in. then you also want to remember when you are looking at structuring these offers, be aware of the risk reward ratio, especially when we're talking about things like contingencies, which we'll be getting into in a minute. And how risky is this, and what's the potential upside for that risk? Then you want to be mindful of sunk costs. Do not chase sunk costs. They'll drag you to the bottom of the ocean and drown you. Sunk costs, if you're unaware, are things that happen once you've already spent the money in the deal. It's gone, right? If you get an appraisal, if you get an inspection, once you do that stuff, it's gone. If you get bad news, don't move forward just because you already spent money. That's chasing a sunk cost. Like, I already spent 500 on the inspection. I'm not willing to walk away from that 500. So you're gonna buy a $500,000 house and make a $500,000 bad decision to save $500, or make it feel like you got value from that $500. That's a bad call. And then be aware of the lost opportunities. If you buy this property, or if you get this inspection, what does that do to you from other ones that you could be going after from a time focus and a cash focus? You want to be aware of those three things: risk, reward, sunk costs, and lost opportunities when you're creating your offers, especially around timing for the lost opportunity stuff.